How did you feel knowing that this was going to happen, that people would be losing their jobs, people would be losing their homes?
I was raving. Wall Street firms, I was angry at the regulators, the rating agencies. I mean, line them up.
How come you're not angry anymore?
That's a really good question. Today we're going to do something a little different. In the past, I've only interviewed guests, and today I'm going to be interviewed. I decided for this endeavor I needed a real professional. So, welcome Melissa Lee of CNBC.
Are you bullish, bearish? How would you characterize your views? How worried are you about the short term? Do you think that what is being done can actually restore manufacturing jobs?
I'm a big believer in the U.S. economy long term, and in that sense, I'm very bullish.
Okay.
But if there's a massive trade war between the United States and China, we won't be fine. Capitalism is great. It creates a tremendous amount of wealth, but it has its dark sides. And then in 2008, that was potentially the end of the world. 2006 rolled along, and that's when things started to get very interesting.
Okay, so what was the first thing that you noticed that was interesting?
I had documents that showed that they were committing massive fraud, like outright manipulative fraud.
Wow.
You know, people applaud me that you predicted the subprime crisis. I was looking for it for years.
Did you like having a movie made about you?
I did. I'll be honest, I did.
Do you think that we could return to that sort of environment, or have we really learned so much that it will not repeat itself?
That is one thing that is scary. Where I'm somewhat has some trepidation is Hi, it's Steve Eisman, and welcome to another episode of the Real Eisman Playbook. And today we're going to do something a little different. In the past, I've only interviewed guests, and today I'm going to be interviewed. And I decided for this endeavor, I needed a real professional. So welcome Melissa Lee of CNBC.
Thank you very much. You set the bar high. You're quite a good interviewer, Steve.
From you, that's very flattering. Thank you.
Well, I wasn't sure where you wanted to start, but I thought we'd start off with today, the here and now, in terms of your views on the market, since it's such an interesting time with a trade war ostensibly going on. Are you bullish, bearish? How would you characterize your views?
I'd say long term, I'm very bullish. And the reason is, I mean, if you go back, prior to 2014, all I did was financials. And that colored, you might say, how I viewed the world. And after 2014, when I went to Neuberger, I expanded and I started researching the entire S&P with a very big emphasis on technology and industrials. And it really altered my view of what was going on because, after Dodd-Frank, the financial system delevered, the banks delevered massively, so you didn't really have to worry about another financial crisis. But I began to see how incredibly dynamic the industrial sector was, the technology sector was. And then with AI exploding, and then you've got the need for more electricity. I mean, it's just all feeding upon itself. So long term, the U.S. economy, I think, is great. And one thing that people don't even think about is the infotech sector of the S&P is 31% of the S&P. But if you add in Amazon, Google, Meta, Bookings, companies that you would consider tech companies but are not technically in the infotech sector, it's like 50%. There's no country on planet Earth that has that concentration. So I'm a big believer in the U.S. economy long term. And in that sense, I'm very bullish.
Okay.
Where I'm somewhat have some trepidation is all the trade stuff. Now, I think what President Trump is trying to do, just as a general rule, is very honorable in that, in the 90s, President Clinton sold NAFTA and China entering the WTO as it's going to improve the U.S. economy growth and it's going to create jobs. And it definitely improved economic growth and it destroyed jobs. So President Trump's trying to rectify that, but it's messy. Last week, as you know, the EU completely caved. They just caved. Switzerland, as of this morning, is caving. Canada is not caving so fast. Mexico is still negotiating. China is playing games with rare earth metals. So I don't know what's going to happen. If the outcome is okay, we'll be fine. But if there's a massive trade war between the United States and China, we won't be fine.
Were the other countries that cave, are those sort of sideshows to you in terms of the impact, it's really the impact of China that you're worried about in terms of defining trade war as an obstacle to the markets.
Well, the EU is not nothing.
Yes.
And
granted.
Canada is not nothing. But at the end of the day, it's U.S. versus China. And we'll see what type of accommodation we can reach with them.
In terms of your technology views, how influenced is the relationship with China in terms of AI and the expansion there? Or can the AI trade and the AI story be a specifically, a worldwide ex-China sort of story?
I actually think it can be an ex-China story. There's plenty of chips to be sold. It'll be better with China, but I don't know how to handicap this. I really don't. Yeah, I've actually gone back and reread some books that I read maybe 40 years ago about World War I.
Right.
I reread Barbara Tuchman's The March of Folly and The Guns of August. One thing about World War I that's so interesting is that nobody wanted World War I. It's not like there was some diplomat in Germany or England said, let's go to World War. They all wanted to avoid it, but they had these very weird agreements between these countries that if you get attacked, I got to defend you. Right. And they sort of all fell into it. So, things are certainly looking better now in terms of the trade situation than they were at the beginning of April, but anything could happen.
I think most investors would say they're long-term bullish. So how do you define short-term, and how worried are you about the short-term, and what's that downside? What is that downside risk in your view?
When I was running my hedge funds, I always thought much shorter term.
Yeah, of course.
And now I think very long term. And I don't really think that much about the short term at all.
Really?
So if I thought that there would definitely be a trade war and that would cause a global recession, which I don't think is impossible, or I think the odds are still fairly low. There were things I would do because that would really have an impact on people's portfolios and my net worth.
Sure. More importantly,
right.
Your net worth.
But barring that, some correction in the market is not something that I particularly think about that much.
So when you get data like Friday's data, the jobs data, which showed 73,000 jobs,
right.
much worse than expected, revisions for prior months, which really shows some cracks right now in the labor market. How do you sort of put that into that want to be bullish? It sounds like you even want to be bullish or at least positive in the short term, that, those outside risks are really small risks in terms of global recession.
I think the labor data is just not important.
It's not.
It's not important.
People lose their jobs, they don't spend money, that's not important.
No, to the people who have lost jobs, it's very important.
But it's important to the economy, no?
It is and it's not. I think the slowdown that we've experienced is all trade related. That, companies are nervous, they've pulled back, they've ordered less, so there have been some layoffs, they're hiring less. Get through this period of trade stuff, and we'll go back to normal. Even
though back to normal is a much higher baseline tariff, at least 3 times what it was prior to this.
It is definitely a higher baseline tariff. And I actually don't know the long-term implications of it. I don't think anybody really does. Although I think the economists who were screaming and yelling gloom and doom that the global economy was going to come to a screeching halt look silly at this point. So does that mean that the global economy might grow somewhat less? Possibly. But I don't think that's particularly important at this point.
I've interviewed you many times over the course of probably years now, and you're pretty steadfast in your views in terms of being pretty optimistic, wanting to look at the sort of bright side of things in terms of the markets. And then you have Wall Street, which is really flip-flopped. Strategists have flip-flopped on their targets. Like the markets start going up, they raise their targets. I don't know if this has happened in the past. I feel like they're changing their targets real time much more often than in the past. Economists also changing it. Granted, it's a tough job. But are you surprised at sort of this?
I'm actually not surprised by that. And I think the problem is that we all went to college, at least people in the markets did.
Right.
And everybody at least took Econ 101. Mm-hmm. And economics is a very I mean, it has flaws as a discipline, but when you learn it, it's kind of an overwhelming, like you become proselytized in a way because there are charts, there are graphs, there's math. How could it be wrong? And, one of the things that you learn in Econ 101 is free trade good, tariffs bad. And tariffs partially caused the depression. Everybody in the market has that religion. And then President Trump comes along, and he's like the Antichrist in that sense.
Right.
And so people have found this very, very jarring intellectually. And at first they didn't know what to do about it. Now they're like, okay, that stuff that they taught me in Econ 101, it might be right very, very long term, but it's not really having that much of an impact. So maybe I should go back to being bullish. And it's that jarring intellectual aspect that I think is what's caused people to be all over the place.
As you said, you went to college. So
I did.
How is it that you were able to sort of divorce yourself from those views that you learned, that everybody learned, and just stick with, it may turn out fine? Because in actuality, I think that not many people would have guessed that we'd be sitting at or close to record highs.
Correct.
on the equity markets.
Partially because of my research before the financial crisis, I have a different view of the underlying economy than most people. So, when you watch shows like yours or the morning show with Sorkin, and they put up the GDP numbers, as if that is the be all and end all of the economy. And the problem is it's a very big gross number. One of the things that from the movie that I had this great speaking gig. I had this speaking agent. I got to speak all over the country, all over the world. I went to places in the United States I never would have gone to before. So, you fly to some city in the Midwest, you get out of some airport that hasn't been renovated in 30 years.
Like a time capsule.
You then get in a car and you drive, oftentimes I would speak at a college in the Midwest. And so you're driving for an hour out of the city through towns that haven't seen a home built in more than a generation. It's really quite upsetting. And that's the other side of U.S. growth over the last 30 years. So the fact that, President Trump came in and was trying to rectify that, as I said before, I thought it was extremely honorable. And maybe at the end of the day, things will be better. I don't think the final chapter of this story has been written by a long shot.
If you were to guess as to what the final chapter would be, though, or not even the final, maybe the penultimate, maybe somewhere a few chapters down the line, do you think that what is being done can actually restore manufacturing jobs across the country? And so therefore will help those cities
I don't know which parts of manufacturing are going to come back. But I do think that, for example, as part of the quote unquote big beautiful bill, if you build a factory in the United States, you get to write off 100% of it.
Yeah.
That's pretty impressive. So I do think there's a possibility of a renaissance of manufacturing in the United States. Which parts do I think we're going to build T-shirts? I don't think we're going to build T-shirts, but there'll be parts of manufacturing that I think are going to come back, but we'll see which parts.
When you're doing that book tour, when you're doing the tour, no, I shouldn't say book tour, when you're going around to these different cities, what else surprised you? I would imagine, you hadn't seen anything like that. How do you think that would have informed your view of the financial crisis, of investing, if you were exposed to those areas that had not seen basically any growth for maybe generations?
You talking about pre-financial crisis? Yeah. I've been on this kick for a long time. Pre-financial crisis, what I got exposed to was, my first exposure to it was, I think, around 1997. There was a credit card company called Providian, which was a subprime credit card company. It was a darling of Wall Street. And on the day I met the CEO, the front page of the San Francisco Chronicle was a story about how they were literally ripping their customers off in ways you could not possibly imagine. And that was like the first sign that, maybe not everything in our financial system is kosher. And then my second introduction to it was when I was at a hedge fund where I was an analyst, and there was a company called Household International. It was probably the oldest subprime lender in the United States. Been around for decades. It was a brick and mortar subprime lender. They did subprime home equity. They did subprime auto. And I had documents that showed that they were committing massive fraud, like outright manipulative fraud. And that was like one of my biggest shorts at that hedge fund at the time. And it really shocked me. I mean, I could not believe that a company this was like a major market cap company. This was not a small company, was doing something like this. It kind of opened my eyes that, look, capitalism is great. It creates a tremendous amount of wealth, but it has its dark sides. And that began a journey that lasted for a very, very long time, where I saw the underside of things.
Mm-hmm. So prior to that time, you didn't really think that a financial company would do that, basically.
Not a public financial company.
Right. Like how could you commit such obvious...
It was blatant fraud.
Yeah.
Blatant. Basically what they did was they had a mathematical formula. Remember, their customers are not the most educated in the world. They were making 12% 15-year fixed rate loans, and they were convincing their customers that the rate was 7%. I swear, it was unbelievable.
Convincing.
They were
like
convincing their customers.
I mean,
but basically what they would do is, so it was a 15-year loan at 12%. So they would show you, so if the amount of money that you're going to pay back at 12% over 15 years, if you made those payments over 30 years, as opposed to 15 years, the quote unquote effective interest rate was 7%, which mathematically was true, but a complete manipulation.
Right.
You weren't being offered that rate. And so, customers actually thought that they were getting 7%. Right. It was really quite shocking.
So you had that must have been a great short at the time.
It was a very good short.
Very good short. So you go on with your life.
Yes.
You pocket that information, you keep that in you. And then what is the next thing that happens that makes you think something else is happening here?
Well, you got to go back.
Okay, let's go back.
So in the 90s, I was a sell-side analyst at Oppenheimer. Mm-hmm. And I think I covered 60 stocks. It was an insane coverage. I covered investment banks, asset managers, Fannie Mae, Freddie Mac, Sallie Mae, all the credit card companies.
Wow.
I covered all the subprime mortgage companies, all the subprime auto companies, and then a hodgepodge of other things. It was incredibly broad. And in 1998, I got up in front of the sales. I did things in the 90s on the sell side that they'd probably put you in jail for today because it was so outrageous. And early 1998, I got very negative on subprime lenders for reasons that are not important. And back then at Oppenheimer, for the morning meeting, you had to write a note, mm-hmm. and then you had to present it the night before, and then you would get up, and they'd call you up, and you'd talk your note. So that morning, I was so insane that there was like a lull in the podium as the person who controlled the podium was looking for the next announcement. I rushed the podium. And I said, "Hi, this is Steve Eisman. The following 8 subprime companies are going to go bankrupt within a year." And then I listed them, and then I walked off.
Was there just silence?
Dead silence. Danny Moses, who was a salesman at Oppenheimer, likes to say he turned to his mentor and said, "What just happened?" And all 8 went bankrupt.
They did?
They all went bankrupt.
Within how long?
A year. My prediction was 100% correct.
Wow.
And it had nothing to do with fraud or anything like that. It was involved accounting, and mm-hmm. It's a very complicated story. In 2002, the second generation of subprime mortgage companies went public. And the funny thing was, it was run by the same guys. They just changed the names.
Yeah.
They just changed names. So, as early as 2002, I said to myself, well, I saw this play once. It's the same actors. It'll happen all over again. So, people applaud me that you're such a genius. You predicted the subprime crisis. And what they don't realize was I was looking for it for years.
Right.
But nothing happened. things were fine, but it just kept getting bigger and bigger and bigger and bigger. And I think in the 90s, the subprime mortgage industry at most originated like $75 billion a year. And by 2006, it was $600 billion.
Wow.
It was 20% of the housing market.
Right.
But that's when the credit started to really go bad.
So in like 2002, when you start seeing the same guys just pop up with a different shingle, basically, and you weren't convinced, I mean, was that a difficult, because you knew it was going to happen. What was your call? What was your sort of stance on these companies? Because, feasibly, it could have been a call that was way too early, which of course,
well, I didn't do anything. I actually didn't do anything.
You didn't rate them a sell or say, or warn?
I mean, the characters that were involved back then they don't exist anymore. I mean, I remember there was a firm called Friedman Billings. And Billings, whose first name I can't remember, he was the greatest salesman I ever saw in my entire life. I mean, he would do a call every 6 months discussing the subprime mortgage industry. And it was like a religious cult event. It was like a evangelical event. And he would get on and he would just sing the praises of the industry. And we used to have a rule. By then I was at Front Point. I was running my hedge fund. And Danny Moses created a rule. And the rule was anybody who ever listens to, his name was Eric Billings. Oh, right. And anyone who ever listens, either sits in a room with Eric Billings or is on a call with Eric Billings, is not allowed to make an investment decision for 48 hours.
Because he's such a good
Because you would want to buy a subprime mortgage company after he talked. That's how an incredible salesman he was. It was unbelievable.
That is a talent. That is a gift from God, a gift. Really.
It was a tremendous. I was even tempted. Well, this guy, he believes he's so obviously big. How wrong could he be? It was very wrong. But it took years for that to unfold. So
2002 and after, to the financial crisis, what was happening at your hedge fund? What were you you knew that this was going to happen at some point. What was sort of
we waited.
You waited.
We just waited. We didn't do anything. Mm-hmm. We did other things.
Sure.
We had longs. We had shorts. We did nicely. We didn't blow out the lights, but we certainly had respectable performance. And then 2006 rolled along, and that's when things started to get very interesting.
Okay, so what was the first thing that you noticed that was interesting? That sort of...
Well, the first thing that was interesting was... So the nice thing about making a prediction about the subprime market as opposed to making a prediction about the budget deficit is that the subprime securitization market does a data dump every month. Mm-hmm. Every single securitization reports all its data. Any single type of credit information you could possibly imagine, they report it monthly. It's like the biggest data download you could possibly imagine. And that market literally freezes for 2 days during mid-month because that's when the data comes out. And people analyze it like it's the Rosetta Stone, which it is. But what you're able to do is compare current securitizations versus older securitizations. So, for example, you would look at, let's say it's the summer of 2006. So you would look at a securitization that was done, let's say, in April of 2006. It's only had 3 months so far, let's say. And you would say, okay, it's month 3. What are the 30-day, 60-day, 90-day delinquencies? And how does that compare to the same month for earlier securitizations? And what you saw by mid-2006 is that the, let's say, 30-day delinquencies by month 5 were like 3 times higher than earlier securitizations. And that's when you knew that the stuff that you'd heard anecdotally, that underwriting standards had gone to hell, was true.
So basically, in layman's terms, that the people who were extended those loans more recently, that they were having more difficulty paying than prior years.
And very quickly.
Yeah.
Very, very quickly.
So they were very not qualified.
Yes. And then the second thing that happened, which was to me the canary in the coal mine, and I can't remember the exact date of it, but I think it was 2006, was when the Sandlers who ran Golden West sold to Wachovia. Now, that was a very important event for me because Herb Sandler's older brother had been my father's best friend when they were prosecutors in the Manhattan DA's office in the 50s. So Herbert Marion Sandler actually knew me when I was in diapers, literally. I mean, literally. So when I got into the business, I kind of got friendly with Herb Sandler. Here he was. He was always positive on his company, and he sold.
Right.
And to me, that was the canary in the coal mine, because if Herb Sandler is selling his company, mortgage market is done.
Done. Like that was your takeaway. Not in trouble.
I told him. So the day that it got, I think it was like May of 06, Wachovia had taken a conference room, a big hotel room out in somewhere in Midtown, and Vincent Daniel and I went. I said, Vinny, we got to go because this history. We have to go. So we sat in the back. I think I read the Post or something. I could care less what Wachovia had to say. And then when it was all over, we just waited. We waited for the whole room to clear out. And then I walked up to Herb Sandler, and I hugged him, and I gave him a nice kiss on the cheek. And I swear to God, and I said, this is a direct quote, I said, Herbie, top-ticked that mortgage market, didn't you? And he was such a tough son of a bitch. He said, I have no idea what you're talking about. This is a great deal. That was a moment.
Have you talked to him since
then?
Well,
he's done. I never talked to him about it again. He and Marion have passed. But they got out. They top-ticked it.
So you're highly convicted at that point. So what was going to happen next?
Yes.
What are your next steps? How do you unpack that and implement a strategy?
So what happened to us was, and this is sort of depicted in the movie, but not completely, was, we were equity guys. So we were short New Century, and we were short Countrywide, and we were short WAMO. And the problem was that some of these stocks were very illiquid. The cost of borrow was literally 25%. And it's kind of scary. So we thought, okay, maybe we should go short subprime paper. We had a problem. We had absolutely no idea how to do that. Like, how do you do that? I don't know how to do that. I had no idea. I mean, I knew how subprime paper kind of worked. I had absolutely no idea the mechanics of it. Like, what should I short? I knew very, very little. So in the movie, the way it's described is Lippman from Deutsche Bank calls. He actually was looking for the fixed income fund at Front Point, called us by accident, and we took the meeting. And then he explained it. And the funny thing about that meeting is Lippman, who always treated me completely honestly, can come across a little bit like a used car salesman. That's just the way he is. But he's very honest. And throughout the meeting, my guys were grilling him like, how's he going to screw us?
Right.
And he told you. He said, I'm going to tell you how I'm going to screw you. He says, when you're going to finally want to get out, and let's say the last price you got is 30, I'm taking you out at 40. That bothered us. We got over it.
Yeah.
And then we started doing that stuff in October of 2006. That's when we began to short subprime paper.
Was there any trepidation involved, like on your part, in terms of trading something that you were just not familiar with?
Totally. I mean
most people would not want to do that. That's strategy drift, basically.
I mean, we met him in the spring of 06. We thought about it and researched it for 6 months before we did the first trade. That's how long it took us to really get organized. And I mean, you have to create ISDAs, these type of agreements with firms to be able to do this. This is not trading stocks over an exchange.
Right. When did you start getting more convicted? What else did you see? I mean, you were putting this on, but I would imagine that did the trade get bigger and bigger as time went on?
The trade got bigger and
right?
bigger and bigger. So we did the first trade in October, and then in January we all went to Vegas.
For fun?
For the conference.
Okay.
the securitization conference. 5,000 people at the Venetian in Vegas. The entire subprime world was there. That scene in the movie where he goes like this, that actually happened. And we met everybody. And it was very clear to me from those meetings that this was going to implode. And so we came back and we doubled the size of our positions. And then what happened was in the spring, I call it March, April, the market had a bit of a rally. Now, the reason why it had a bit of a rally was the securitization data came out, and it wasn't the pace of change slowed. And so there was a rally. And we all literally laughed. We thought it was funny because, having covered consumer finance for so long, I knew, and all my partners knew, that people get tax refunds at this time of year.
Right, so they can
So
pay.
of course the data is going to get a little bit better. They have some money.
Right.
So we doubled our size again. And that was kind of it. Because by August, it was over. The whole story was over.
I want to go back, though.
Sure.
So you went to Vegas. What was going on at the conference that made you think that the world was coming to an end?
It was like watching people. I'll tell you a story that wasn't a Vegas story, but that really solidified to me how bad this world was from an ethical perspective. I remember we had a meeting in our offices at Front Point. I can't remember which firm it was, but it was like the securitization trading desk of a firm came to talk to us. I think they wanted to do business with us. And there were senior people and mid-level people. It was about 5 or 6 people. And during the meeting, I think it was Vincent who said to them, explain something to me. I know you know that the underwriting standards have collapsed. You know that this paper is going to go bad. What are you doing? And the senior guy said, oh, yeah, but the way we look at it is after it all collapses, we'll buy it back for pennies on the dollar and make a fortune. And I think Vincent then said, how do you live with yourselves?
Yeah.
And that was the world. The funny thing was he was wrong because what happened was the business got so big that there weren't enough actual investors to buy all the paper. So people like him convinced their own firms to retain some. That's why Wall Street went down, because their own securitization has convinced them to keep some of the paper.
When you look back at that time, do you think that time is, and I don't want to leave that time because I know you have a lot of great stories, but I'm just curious, do you think that we could return to that sort of environment, or have we really learned so much that it will not repeat itself? And I hate to say that because that's a huge prediction, and history always repeats itself, those sort of mantras.
Well, it
but
rhymes,
still.
whatever.
Yeah.
There's an unsung hero of this whole story who was after the financial crisis, which is Vice Chair, Fed Governor Daniel Tarullo, who became the first Vice Chair of Financial Supervision after Dodd-Frank created the position. And I don't know if you remember, he was head from 2011 through April 2016. He's the best bank regulator in the history of the United States, period. Nobody else is even close. I mean, I'll just give you an example of what he did. Pre-crisis, Citigroup was probably levered officially 33-1. If you add in all the stuff that was off balance sheet, which eventually came back on balance sheet, it was well over 40. When he was done, they were levered 10-1. That's like the distance from Mercury to Pluto. It's literally that different. So, and he also made them de-risk. Even within the context of the leverage. And we had a big impact because every 6 months Jamie Dimon would get on CNBC and bitch and moan about what Daniel Tarullo is doing to me.
So it was working.
So it worked. So there are very few subprime mortgage loans made in the United States. I don't think there are really any. 30 years from now, could it happen again? Maybe. This administration will certainly allow banks to lever up a little bit more, but we're never going back. Within a time frame that matters to us, we're never going back to that.
Even if there's sort of a push, like a right to home ownership, I feel like that sort of embedded belief in the United States that everybody has a right to own a home. Mortgage rates are too high, they should be lower so people can buy homes.
But the problem is that if you were to make a subprime mortgage loan, the capital requirements to put up against it are basically prohibitive.
These
so you're
days,
not going to do it.
Yeah. Going back, though, because I know you have a ton of stories. I want to hear them.
Sure.
What is the craziest story that you heard in terms of the ones that you actually came across that helped you build that conviction to make this trade?
So this is not a story. This was a number. This was like numbers.
Mm-hmm.
So, when you looked at securitization data, you got a lot of credit data, but there was more than that. You got, what percentage of the loans are in which states. But the most important statistic to me was what percentage of the securitization is no doc, low doc loans. So let me explain what that means. I mean, I go way back with the subprime mortgage industry. Oppenheimer bought public in 1992 a subprime mortgage company called Ames Financial, which actually lasted a long time. So I knew the chairman, and I remember the first time I visited them, I sat in on loan committee. The chairman of the company was on loan committee. He literally was part of the underwriting of it was a small company.
Right.
Was part of the underwriting of every single loan that they did, subprime mortgage company. And so case number one, there was a file like this thick. I mean, they knew everything about this person, literally everything. And I asked him, why is the file so thick? And he said to me, well, who do you think we're lending to? We're lending to people who have problems. So we need to know as much as possible about this person before we're going to give them a loan. That was subprime 1.0. I would say by 2006, at least about 50% of all subprime mortgage loans made in the United States were no doc, low doc. And
So
what that means either
this.
was like that thin, stated income, meaning they didn't even pull your
Verify
W-2.
it, yeah.
They didn't even verify you. They just asked you what your income was. So that's like no underwriting. I mean, the joke I always like to say is that by 2006, the mortgage standard underwriting standard of the United States was, can you breathe? If you can breathe, we've got a loan for you.
And that's exactly what it was.
It was.
I mean, the stories then were, people who are waiters and waitresses and nannies, and they would, apply for a loan and they would buy a townhouse.
So I have a funny story. So in 2006, I had to go to a gastro doctor. So he did an examination. It was no big deal. And then we sat down, and he says to me, this housing market's crazy. What's going on? At which point, I laid out for him what was going to happen.
He was probably shocked.
And the word I used was Armageddon.
Wow.
Okay. I'd say early 2009, he called me up. He said, it's time for you to do a colonoscopy. Okay. This is a true story. And so I come in. Back then, he used to do it in his office. And so I'm on the table. I got the IV in, and we're ready to go. And he walks in. And so there's the anesthesiologist is in the room. There are 3 nurses in the room and this doctor. At which point he says, do you know who this guy is? This guy predicted the housing crisis. At which point everybody in the room starts telling a subprime mortgage story. Each nurse in the room had a subprime mortgage story that was like tragic.
Like they took out the loan,
they took out the loan,
house.
or it was their cousin or their sister. Each one of them, either they or knew someone who had a subprime mortgage loan where they lost their house. This went on for 15 minutes until I finally said, I really got to get to somewhere after this. Go get this thing started.
Before, though, when you were making those predictions and you're telling this doctor, for instance, that it was going to be Armageddon, what kind of looks did you get? Were people skeptical? Were they welcoming? Were they like, I shall look into it?
I remember, again, in 2006, I was at a charity event. And sitting next to someone who his kids went to the same school as my kids. We knew each other a little bit. He was an investment banker. So we started talking. And so he asked me my thoughts about the housing market, which, as my wife would say, it's the Steve Eisman Sturm and Drug horror story. I told him. I predicted everything. That was going to happen. And again, I used the word Armageddon. I didn't see him for 2 years, till well after the financial crisis was over. And I forget where we were. And he said to me, he said, you know, do you remember this conversation we had? I said, yeah, I remember. He said, I thought you were a raving lunatic, literally. And then everything happened exactly as you predicted. So my wife, Valerie, used to have a rule after that. She said, when we would go out for dinner, you are forbidden from talking about the housing market and what you think is going to happen because people need to digest their food.
Unless they just don't believe you and they just think you're crazy.
Well, most people did think I was literally crazy. They
Even
thought I
when
was
you
insane.
walk them through what you were seeing, they didn't think there was any.
It was so beyond the realm of possibility for most people to imagine that this could happen. It really was.
How did you feel knowing or being highly convicted that this was going to happen, that people would be losing their jobs, people would be losing their homes?
It depends what year you're talking about.
Okay.
So 2007 was really the implosion of the subprime mortgage market, but the U.S. economy was still okay. And if you know anything about how the subprime mortgage trade worked, it was a zero-sum trade. So if I made $1 million, somebody on the other side lost $1 million. It's not like buying a stock and I make money and no one's on the other side. Or they can be, but they don't have to be. This is a completely zero-sum trade. And everybody on the side of that trade, I hated their guts because I felt like, we could talk about it, the subprime mortgage loans were actually unethical.
Yeah.
And that Wall Street was involved with it was a travesty. So the fact that I made a lot of money on the back of all the people who made those loans was glorious.
Right.
I enjoyed.
You thought they deserved it.
I thought they deserved it, and they should all go down for it. And then in 2008, that was not fun because that was potentially the end of the world. You know, what shocked me about 2008 the most was, and this was me and all my partners felt this way, we knew things were so bad that literally the world could implode at any second. But the saving grace, we thought, was that surely the government knows what we know and they've got plans. Because it's that bad. It's that bad. It's so obvious that it's that bad. And we were 100% wrong. And the only time I really found out that I was 100% wrong was when your colleague Andrew Sorkin published Too Big to Fail. And there's a scene in Too Big to Fail which, if it wasn't so tragic, it'd be comedic, which is, it's right after Lehman has fallen. All the big muckety-mucks are in some room at the New York Fed downtown. And somebody walks into the room and says, AIG is about to fail. And it is a complete shock to everybody in the room. What do you mean AIG is going to fail? They had absolutely no idea that AIG was involved in subprime trade. And after reading it, I laughed. I said, don't these people read the research? There's a lot of sell-side research that just told you that. But they had no idea. They had no idea at all.
It was like watching a car wreck at that time.
Totally.
I remember being on the air over the weekend when AIG was about to fail. All of this was happening.
Yes.
And it was just, we were gobsmacked. I mean, literally all of us getting the instruction, AIG is going to go under.
The only thing that I liked about the fact that AIG went under, or almost went under, was that one of my biggest shorts in 2005 was AIG, because I thought that some of the things that Hank Greenberg was doing back then, which had nothing to do with subprime, were criminal.
So nowadays, people like to try and find the next Armageddon.
Oh, they love it. It's like a game.
Right. They want to be Steve Eisman.
Yeah, I said that on your show. One of my better lines.
It was one of the best lines you've ever uttered on TV, maybe even in real life.
Maybe.
Why do you think there's a preoccupation? I mean, it feels like since the financial crisis, everybody wants to find out what, or identify, predict the next crisis, the next disaster.
I guess they want to have a movie made about them.
How did that turn? Did you like having a movie made about you?
I did. I'll be honest, I did. I mean, it was very flattering. You know, it reminds me. I live an experience which the only person I've ever told this to is my wife, but I'll reveal it here. I live The Man Who Shot Liberty Valance. So let me explain. So The Man Who Shot Liberty Valance is one of the iconic westerns, which I am sure most people who are listening to this have never watched. I'd recommend you watch it. It's an unbelievable movie, and it's not your typical western.
Okay.
So The Man Who Shot Liberty Valance stars Jimmy Stewart, John Wayne,
Wow.
and Lee Marvin, who's the bad guy, Liberty Valance. And the story is Jimmy Stewart is a lawyer who shows up like in some town, I think like in South Dakota, which is a territory. And John Wayne becomes his friend, and they're both like competing to get the girl as part of the story. And Lee Marvin is the bad guy, and he takes a hate on Jimmy Stewart and challenges him to a duel. Now, Jimmy Stewart doesn't even know how to shoot a gun, but he's a gutsy guy, so he says, okay, and they have a duel. And he shoots and he kills Lee Marvin, or Liberty Valance. And because of that, he becomes this iconic hero in the Dakotas, and he's instrumental in making it into a state. He gets the girl. He becomes governor of the state. He becomes senator. And then he becomes ambassador to England. And it's years later now, and he comes home and he's retelling this story to two reporters, a senior reporter and a junior reporter. And then he tells them, I didn't shoot Liberty Valance. What had happened was John Wayne was standing on the side knowing that his friend was going to get killed and took out a shotgun and shot Liberty Valance as they were about to shoot.
Right.
And Jimmy Stewart found about this later. And so he says, I'm not the hero that people think I am, because it was John Wayne who did it. But I lived the life of the hero.
Right.
Okay. And then he leaves. And then there's this line, which is like one of the best lines in all of movies. So the young reporter says to the senior reporter, what do we do with this? And the senior reporter says, and this is almost a quote, but it's close enough, something like, in the West, when confronted with the truth versus the legend, print the legend. And I feel sometimes that I lead that life. Look, I did make a great prediction.
You did.
But there are a lot of reasons for it. I mean, I didn't save Western civilization. I made money at it.
Right.
But they made a movie at it, and they made me into this really great guy. Steve Carell played me. It's very flattering. And I think there are all these other Wall Street guys who want to have that experience, I suppose.
They want to be you.
I guess they do.
Or Mark Baum.
Right, Mark Baum. Exactly.
Were you, Mark Baum was sort of a jerk.
A little bit.
Yeah.
Well, I was kind of jerky back then,
You
too.
were.
You know, when the movie came out, people asked me, what'd you think of the portrayal? Yeah. And my original response was, first of all, I said, I think it's a great movie. I think he played a great character. But I don't think I was quite that angry. And that movie came out like in early 2015. And in April of that same year, the Financial Crisis Commission did a data dump. They literally put out every single piece of paper that they had. And one of the pieces of paper that they had was my interview that they did with me in 2010. Now, I hadn't thought about this in years. It was a transcript of my interview. Anybody who wants to read it, I'll just type in Steve Eisman Financial Crisis Commission on Google, and it'll pop up. And so I read this. I was borderline insane. I mean, I was so angry at what had happened and who had participated in it that I was raving.
You were angry most at Wall Street firms?
Yeah, I was angry at Wall Street firms. I was angry at the regulators. I was angry at the rating agencies. I mean, line them up.
Right.
I was unbelievably angry, and it really comes across. And so I said, no, Steve Carell got it right.
But you were angry for a good reason. I mean, you were angry because you saw the writing on the wall and you felt that somebody should have done something about it.
Oh,
right?
Absolutely. Nobody did.
And nobody did. And nobody wanted to listen.
They did not.
Did you feel like the man shouting at the cloud?
Something like that.
Right?
Something like that. You know, there was a funny thing that happened at Front Point. I think it was in it was definitely in '07 at some point, like in the spring as things were starting to get really bad. We decided to do a conference call. Now, we would always have conference calls with investors, but this was we weren't the only fund that was doing the subprime trade. That fixed income fund that they tried to call, they were doing it too. So we had a call. Yeah, like normally there'd be 75 investors, but I decided to be a little sneaky. I put it out to all my buddies in the financial services mafia that we were going to do a conference call, and I gave them all the phone number. There were 1,000 people on the call, and I wish I had a transcript of that call, because the other fund, they never even got a chance to talk. I didn't let them talk. I just went off on everybody, from the mortgage insurers, rating agencies, Wall Street, you name it. I went after them all. I was raving.
Wow. How come you're not angry anymore?
Well, it's over.
Well, yeah, but wasn't that part of your personality, like that intensity that...
Yeah, but you can only scream at windmills so long. Torillo did what he needed to do. The only thing that didn't happen was nobody went to jail, which is a travesty.
Right.
But can't be angry at that forever. Right. But Wall Street's not the same place that it was.
Yeah. But even just, Porter and Vinny and Danny, they joke that this is the relaxed Steve Eisman now. You're good with things. You roll with the punches. And there's like a real change in your mentality.
Yeah, look, I got older. The war that I fought was over.
So going back to the Armageddon and people wanting to find the next, what do you think people are getting? The deficit, for instance,
yes,
is one area that people are saying, oh, this is an unsustainable path. This is
right.
This is going to be the next thing that's going to create global chaos.
Correct.
And you think that's nuts?
It's not that it's nuts. It's that, well, first of all, it's not like the subprime trade where you got data every single month to see if you were right or not.
Right.
Okay. Every month you look at the data and you go, still bad, getting worse. Let's do more. This is very, very big. And, as I've said on your show several times, the people who come on, it's Wall Street's version of virtue signaling. I'm so against deficit. I'm a good person is basically what
right.
people do. And what they never really talk about is, okay, all other things being equal, it would be better if we had a smaller deficit. I don't think anybody disagrees with that. But what they never talk about is, well, why has nothing bad happened? Because if it's so bad, why isn't it bad?
Right.
That's the obvious question. And my answer to the question is that, why what happened to Greece hasn't happened in the United States is basically the question. And I think the answer is, unfortunately for Greece, they're not the reserve currency of planet Earth. And it's more than just being the reserve currency. It's that if you figure out how the guts of the banking system work, it functions on treasuries, and there's no alternative at this point. So as long as there's no alternative to treasuries, we could do pretty much what we want, as much as nobody wants to say that. Now, it's if crypto becomes so huge that it becomes an alternative, or Chinese bonds become an alternative, then it's a different situation. But we are so far away from that we have the luxury of time to fix our problems. Whether we'll fix them or not, I don't know. But we certainly have luxury of time.
Right. What are your highest conviction trades now?
That's a really good question.
Or do you have any?
I actually do. I have a bunch. So I don't own the entire Mag 7. But I own a lot of it. I don't own Tesla, but I own Apple, Google, Meta, NVIDIA, and I own some. My portfolio is very tech oriented, so that's a big conviction. I just think,
which is a consensus trade,
and it's a total consensus trade.
Does that bother you? Does that worry you?
I don't lose even. I don't even lose a minute. I don't even lose a minute of sleep about it.
Okay,
not even a second. I think the new thing is that we are definitely entering an M&A wave in the United States. That's starting to become very clear. So I own PJT Partners, as just one way to play it. You know, people could play it different ways. I mean, the fact that Union Pacific is buying Norfolk Southern, when you think about it, is shocking.
Yeah.
Because during the Biden administration, they not only would they have not done it, they wouldn't even have thought about it.
Yeah. They wouldn't have uttered it.
Forget about uttered it. They wouldn't even have allowed the thought to enter their heads that perchance that the government was listening. So somebody in the government must have given them a wink and a nod that you can do this, because otherwise there's no way they would have done this. So if that can go through, anything can go through. So we're definitely going to have an M&A wave. We should have an M&A wave in regional banks.
Yes, I was going to ask you that.
But you know, this most recent one, the stock didn't react so well. Synovus and Pinnacle. So I don't know how that's going to work out, but we definitely need larger banks to compete with J.P. Morgan and Bank of America.
Right. Do you have trades associated with that?
I don't have any.
Okay.
I keep thinking about it. I mean, I'll give the name that should be sold. There's no question. Comerica should be sold. It's not even a question. The price of a Comerica today is where it was in 1994.
Wow.
Literally. So that actually has a very good footprint and should merge with somebody else. But for whatever reason, the people who run it don't seem to be amenable. So those, and then, you know, I have a hodgepodge of things. You know, I own Apollo as an alternative, as a long-term alternative play. And then everything, I generally look for things that have real market power. So, like, for example, I own Moody's because it's a duopoly. Right. On the other hand, those type of trades don't always last. So, for example, I don't own this. I have no skin in this game, but I'm sure you saw what happened to FICO of late. Yeah. You know, FICO was a monopoly, and now all of a sudden it's maybe not going to be a monopoly, so the stock's really corrected a lot. Right.
How do you like podcasting? You have
Love it.
You have a makeup bag now, Steve?
I do have a makeup bag.
You have like a podcast look.
I do. This is it.
The whole thing. I mean,
I really am enjoying myself tremendously. Yeah. You know, one of the things, first of all, I interview a lot of analysts and give them a real opportunity to talk for a very long period of time.
Which is great. They can actually explain
explain their stuff. We're going to drop something, but by the time this comes out, it'll be out already. A friend of mine who's a venture capitalist, to talk about what's actually really going on in venture capital. It's venture capital is just emerging from a depression over the last several years, which is not something that you read about.
No, you think of only tech, and you think of AI, and you think of all the things.
Yeah, and you think about and all that is true.
Right.
But most of venture capital is actually in a depression outside of those areas, which is fascinating. And then, you know, I read a lot. And so one of the nice things, and this is a benefit of the movie, is I can read a book and contact the author and say, hey, it's Steve Eisman. You want to come on my podcast to talk about your book? And they do. Yeah. So I interviewed this guy, Patrick McGee, who wrote this really good book recently called Apple in China. And it was all about how Apple literally fell into manufacturing 100% of its products in China. You know, when Apple says that they manufacture stuff in India, it is not true. Right. The actual manufacturing takes place in China, then they ship it off to India where it's reassembled. And that was fascinating. And the one thing that was interesting about the book was there was never a moment where there was a meeting at Apple where somebody had a deck and they said, and they laid out, this is why we should manufacture in China. It just evolved. It just evolved over time.
As with so many other companies, it just happened.
But the problem for Apple, and I do own Apple, is that if you manufacture 100% of the stuff in China, you are completely captive to whatever happens between President Trump and China now.
Right, but you still own it.
You have no escape.
There's no discount embedded, though, for a trade war.
That is one thing that is scary, because if there is a trade war between the U.S. and China, then Apple could have some serious problems. Right, but you're not hedged. I'm not hedged.
You're just long?
I just owned it.
I'm going to look at the bullish side of things.
It'll be all right.
Steve, it's been a pleasure.
Thank you.
Thank you for inviting me onto your podcast.
Yeah, no, really. I'm happy to come back on your show. This podcast is for informational purposes only and does not constitute investment advice. The host and guests may hold positions in stocks discussed. Opinions expressed are their own and not recommendations. Please do your own due diligence and consult a licensed financial advisor before making any investment decisions.